Stocks are the hardest instruments to trade properly. You're capital bound, you're exposed overnight, and you're exposed to earnings, and you can't scale in and out like you would with other forms of trading. And yet, most traders handicap themselves even more by doing one thing, and that's hitting buy at market price. I have not bought a stock at market price in 2 years, and most traders shouldn't be doing this either. Let me explain why. When you trade stocks, you're dealing with macro earnings, you're dealing with analyst revisions and overnight gaps. You don't get the luxury of having tight intraday stops and immediate flips like other types of traders. And on top of that, you're committing some serious capital. If you want to own just 100 shares of a single stock, if the stock is trading at $70, you have to tie up $7,000 to even own 100 shares of your favorite stock. So entries matter even more than you would think, which makes this even crazier because people just hit buy at the market price and when the candle is green. This is not trading at all. This is reacting to current price. And the problem when you buy at market price is you accept today's emotional price. Whatever we're trading at very much currently is what you're getting. And if the stock dips 3% right after, you're instantly underwater. If volatility spikes, you're going to panic and you're just hoping that it continues up immediately. Trading like this, you have zero structural advantage. You're betting on the direction that it is only going to go up. Instead, I negotiate my entries using puts. So if I want a stock, I don't buy it at market price. I will never buy it at market price. Instead, I'm going to find a spot that I want to own the stock at, say at this support level, and then put a put at this area, meaning if the stock drops to this level, I will own the shares at this level. You are agreeing to buy 100 shares of this. So something with Robinhood where this would be trading at around $70, you would be tying up 100 shares, meaning you're tying up $7,000 worth of capital to own the shares at this level. But my signature trick is the market will pay me a premium for making this promise. This is what all of my videos are about. This is what happens immediately. As soon as I make the promise to buy at this level, I get paid that instant premium immediately, which will probably be around $100 just for agreeing to own the stock for probably a week. Now, instead of trading with zero edge, I have cash in my account already from just starting off this trade. So we've used Robinhood as an example for a lot. We can hop over to something else like Dell, which is another position that I have currently. Let's say Dell is trading at currently $118. This means if you were to buy 100 shares of Dell, you would have to set aside $11,800 of your portfolio to do this. Now, you're agreeing to buy those 100 shares if the price drops to that level. So 118 is that current price, but as we can see, this 112 level is where I'd want to own it at. We have a good support zone right here. So this would be a safe spot for me to own it at, which means that if we were doing this at 112 times 100 shares, you are tying up $11,200 to make this trade. This means you are committing that $11,000 to the trade, but the market might pay you over $200 just for agreeing to make this trade. So if it drops to this level, you're buying your favorite stock at a discount, and at this point, it is at a 4.77% discount. So almost a 5% discount we would pick up Dell for, and you keep this $200. Now, if the stock just continues up over that period of time, you still keep the $200, but you don't own the share at all. Even if it goes sideways for the remainder of, say, a week of the expiration, you still do not own the shares below this level. Now, let's say you did buy at market price at 118 and it immediately drops to this 112 level. This means that you're immediately in drawdown around 5% on the trade, where I would get tagged into the trade here, and I've already been paid around $200 for agreeing to make the trade. So now I have money in my pocket, I'm buying it at a 5% discount, and my upside is way more. Now, I'm not banking on just making premiums to live off of. These are not some quick flips. These are trades that can last weeks or even months. Sometimes I'll sell a put for several weeks before even getting assigned, and sometimes I'll own shares and manage them for months. This is position architecture and it's not candle chasing. If I like Dell currently trading 43% off its highs, I can sell a put at a lower price, say at the 112 level, start a swing trade that could last anywhere from a week to over a month to even maybe 6 months, who knows, where we would continue just having Dell creep up like this, and we would keep selling calls on this all the way up to keep earning that income generation on the open P&L. And once I find a place where I do like that I want to sell, I would just sell the shares using a covered call position, and this is where I would get paid to exit my trade along with a stock percent gain. So again, we're probably getting $500 for exiting the trade if it's above where my share price is, and then we're earning a percent gain on anything above where the share price is. So for that example, let's say I do get assigned, and in a case like this, I was assigned at the 136 mark on Dell. Now I own 100 shares at that level, so that's the 136 right here. I own 100 shares. Most traders will panic if the stock dips after this. I don't at all, and as you can see, the stock was dipping for a long period of time ever since I owned this, and we are still way below the current level that I would like to be at. But how do you take a trade that is in the losing position right now and turn it into a winner and earn income on top of the open P&L? So let's say we are assigned, we own the 100 shares. Now we're going to sell a covered call. So a put is for the way down, and a call is used on the way up. The call just means you're agreeing to sell your shares at a higher price. And once again, the market will pay you for that promise, even if the stock is recovering slowly. So with Dell sitting below this level the entire time, my share price is right here. I'm selling calls all the way up here. Now, in 1 week to a month, Dell is not jumping over 21%. This is probably like 25% all the way to this area right here where my covered call is being sold at. Dell is genuinely not jumping that far unless we have something crazy go on in tech. But I'm still earning money at doing this. So with selling the covered call at a higher position, I'm still earning that premium, which is probably around $100 to $200. And that's for, say, a week to 2 weeks of agreeing to sell the stock. But the stock is in drawdown right now. So even if I'm open P&L minus $2,000 on the stock, I'm earning around $100 to $200 per week until it comes back and I can sell the shares. So if this rallies strong, I'm getting paid twice, from stock gain and from the covered call premium. If this stays flat, I'm just going to keep collecting income as I've just been genuinely doing. Ever since Dell's just dipped and continued like this sideways motion, I've just been selling covered calls on this and earning premiums on this open P&L. This is why I do not panic in drawdowns, because structure is built to monetize over time. Your expiration does matter on this because you choose how long to hold that contract and how long that'll last. So weekly options are more precise. You can have faster adjustments and higher annualized returns, but you do require a lot more accuracy. Now, for someone that's on the charts every single day like myself, I am using more like weekly options, and I kind of only use calls for, month-long positions if I choose to do that. So I do prefer the monthly options for calls, but I do prefer the weekly options for puts just because I like the bigger cushion and the upfront premium that I would get from the monthly call. But I do like the weekly puts because that's where I would earn this for holding for the week. For beginners, I would say this is a 2 to 4 week expiration thing where as you get better, you can tighten up your time and how far in advance you want to be selling those options at. Now, there are risks with this. The only way this works is if you actually like this stock long term. Dell is a company I still believe will be around in the next 10 years and doing very, very well. So for me, I'm okay holding this long term, even though that we are in some crazy drawdown right now. I have every intention of selling this when we get back to the highs, but for now, I'm not horribly, down on the stock itself. As you can see, like its past performance, we are naturally trending upwards, and a healthy stock will continue to do so. I'm personally very happy with this position, continuing to make income on it. But you have to be careful when you're owning at least 100 shares, because this is when stuff gets real. Your P&L can look pretty scary when you own 100 shares of any stock. But overall, the biggest thing is going to be that you want to be diversified. This is a big one because if all your eggs are in the tech basket and tech as a whole drops, everything in your portfolio is coming down with it. But say you have healthcare, you have financials, you have tech. When one does this, one might be doing this and the other might be doing this. So naturally, when you're diversified, you have much more of that spread out and a little bit easier on the mind and the emotions. Because yes, you can be in drawdown. Yes, stocks can keep dropping. And this is why stock selection matters so much. This is not a shortcut. This is structure. I only will choose to sell a put at a support level. If there's no support level, I will not sell a put because I will not want the stock to just go into this free fall where it could dip all the way down to these levels if there's no supports. Take Robinhood, for example, right now. We own shares at $108 right here. As you can see, we got assigned at this level and Robinhood has just crashed from there. We're down almost 43% on this currently, but have I sold my shares? No, I've just continued doing the income generation method of selling covered calls at higher levels. Now I'm doing this so that I can continue earning income because Robinhood is a great stock to me. Personally, this is never financial advice, but I saw their earnings look good. Obviously less participation with crypto users did bring this down a lot. Overall, they did have a decent earnings anyways, beyond the, that surprise that we had on the revenue side. But overall, I do think Robinhood will come back in the near future. So I'm not too annoyed with this position being in crazy drawdown because I'm still earning those covered call premiums as income on the open P&L. So again, once this comes back and is above my share price, I can choose where I want to sell it at for a percent gain, and I can sell it with a premium of probably around $400 to $500. So immediately I'm debited $400 to my account, and then I'm selling for stock gain as well. Stocks are very hard to trade, but why make it harder reacting to today's price? You can keep chasing your candles, or you can choose your price, get paid first, and let time work for you. So I never buy stocks at market price. I just make the market negotiate with me for where I would want to own it at and to pay me to do so. That shift alone changed everything about how I trade. My swing trades have much more structure. Even if we go into drawdown a lot earlier in the trade, I still have a way of generating income on the open P&L, and I'm never stuck bag holding. Let me know if you guys have any questions or if you want me to make a video on a certain topic that I talked about in this video. But if you found value in this video, make sure to leave a like, subscribe, and we'll see you guys in the next one.